the purpose of having NEDs on the board was to have an independent review to be taken up. Then So the case study, what we have done, we looked into, see what was the flaw in that particular situation, what is the appropriate thing, and then also later on we have um, learned about the nominations committee, and then see there was a recommendation which was to be given in that particular case about what is the purpose and the benefit of having a nomination committee in the organization. So simultaneously while learning that, we were able to connect it to that. So then we did understand about the disclosures, what are mandated disclosures and the voluntary disclosures. Basically, the purpose behind taking up any voluntary disclosure was to um, ensure that the information is provided to the stakeholders, because stakeholders seek information from the organization for better decision making. So that was the purpose behind that. So for that reason, voluntary disclosures are taken up. So in that context, we did look into the social environmental issues, the sustainability aspect of it, see what plans the organization has in terms of sustainability, what is sustainability audit, then the carbon footprint, the amount of pollution that is emitted from the organization and what measures are taken, and the management systems which put a check on the environmental issues that are created by the organization. We have EMAS and then ISO 14,000. Then later on, we also did learn about an important concept called as integrated reporting. See, in the of late, this topic is being tested in the examination. So here as part of stakeholder analysis, because stakeholders are seeking information from the organization, the best possible way to provide information to the stakeholders is by way of integrated reporting. So that's the concept what we understood. The 6 different types of capital under the concept of integrated reporting. The financial capital, anyway, it is disclosed in the financial statements. It's already reflected in the financial statements. But then we also have learned about 5 other different types of capital. The reports on these capitals are integrated with the report on the financial capital. Therefore, it's called as integrated reporting. Now, integrated reporting is taken up and the information is disclosed for the benefit of the stakeholders for better decision making of the stakeholders. So that's the concept. After that, we did learn, we have started with this concept of what is internal control system. Okay, to ensure that there are no fraudulent behavior or frauds happening in the organization, or accounting fraud, specifically accounting fraud happening in the organization, instead of an external auditor giving a view about that, if it is better to have a control system within the organization that every organization has to adopt. So that was the context in which we have looked into. Then the internal control definition. So it says that the internal control system is a network of systems established. So ultimate aim is to ensure that the organization objectives are achieved. Okay. In terms of what are the objectives of the system, internal control system, to be more practical, there would be orderly and efficient uh, operations carried on in the organization. Assets are safeguarded, prevention and detection of fraud and error, accuracy and completeness of records, and then timely preparation of financial information. We understood that, see, the internal control system should not be a separate system, but then it should be embedded with the regular activities of the organization. Then there should be the control system should be able to respond to the changing risk within and outside the company. So how do they respond? So there is something called as noting down of various events, and then what impact do these events have um, on the organization. So what is the amount of monetary loss that can happen on account of happening of the event. So internal, external, whatever events happen, they do make a note of it and then quantify the monetary loss. So assess what would be the impact of that. Then includes procedures for reporting control failings or weaknesses. um, the roles and responsibilities of different people in the organization also we did look into that. What is the role of board of directors, senior executive management, heads, and all employees? There are five components in the internal control system. The framework that is given by COSO has five components: study about the internal environment, the risk assessment, control activities, information and communication, and monitoring. So um, study the internal environment thoroughly about who are they, what are the policies and procedures, what is the responsibility of each of them, then what is the seriousness of the management, and what are the employees about their um, moral ethical standards, etc. So everything about the internal environment first should be studied. After that, the amount of risk that is present has to be quantified. It has to be calculated, risk assessment. Then different control activities that are to be taken up to ensure that fraud does not take place. So that is in terms of restricting the access to employees to be present or use the assets of the organization. There are segregation of duties. So no individual should be assigned with more than one task. Okay, so that will keep a check on if at all if there is any fraudulent behavior. Okay, then we see that all information that is required um, to understand about the risk aspects have to be gathered and also to be communicated to the people in the organization. As things are implemented, there should be continuous monitoring. The three levels of management also I did explain to you. The strategic level is involved in planning for the entire organization as a whole. Tactical, in detail, intricate planning by assigning the task to departments or individuals in the organization. Also use the resource allocation. Operational level, they are involved in implementation of the strategies, but at a day-to-day level, they also are involved in planning. Okay, so these are the three different management levels and the planning that they are involved in. Information flows for management. See, when information is provided to the management takes decisions. So the first thing is the information has to be gathered. It has to be the facts and figures, when they're gathered, we call that to be as data has to be processed to make it as information is um, analyzed, and then the analysis is provided to the management so that management takes better decisions, useful for decision making. Attributes of information, the information characteristics, and then at what levels they are affected. So that's till that point we have learned yesterday. So today we'll start with fraud risk management strategy. Okay. Any doubts in what we have done till now? Quite a large portion we have finished. So any doubts, anything, anywhere? Okay. As usual, silence. Okay. Fraud risk management. Okay. So what is fraud? What is error? Anyone? Would you like to share your view about what does it mean as fraud, and or how do we differentiate between fraud and error? Anyone? even if it is uh, yes, that's right. Very good. Fraud is intentional and error is unintentional. Both of them, it is about some happening of something wrong, which is not appropriate. So, which is not the normal thing that has to happen. Um, See, that is error, a mistake, something which is not supposed to happen. The same thing is with fraud also. But somebody committing a mistake unintentionally, we refer that to be as an error. But then someone is intentionally bypassing the rules and then is involved in doing something wrong for their personal benefit. That is called as fraud. So now here the purpose of having an internal control system is to ensure that the fraud does not happen in the organization. It is eliminated. That is the purpose behind having an internal control system. So now it is important that every organization has an internal control system. So now um, depending on the organization structure, they would have their own control system with the policies and procedures defined and then communicated to the employees. Now everybody understands because it's already communicated about the details about what is not appropriate, what is considered to be as fraud. Okay, then when they are communicated about that, so then they would not be involved in fraud. So that is the intention behind that, and then organization can run smoothly. The whole purpose behind having all this is that. Okay, now we have fraud risk management strategy. So in terms of managing the fraud risk, see, fraud risk, if it has to manage, so the management has three different key elements or three different stages this can be dealt with. The first one is fraud prevention, second is fraud detection and fraud response. Fraud prevention, all possible measures taken up to prevent the fraud from happening. Any idea what could be a possible thing about um, preventing the fraud from happening? Is there any possible um, way in which they can stop the fraud from happening? Randomly, any idea, doesn't matter. Randomly, how is it possible to prevent fraud? Any one of you, what can be done? Please think and tell. You randomly anything roughly. What if you were a manager? If you now you are studying this to become a leader, isn't it? You by passing this examination, ACC exam, you will be exhibiting your ability to become a leader, isn't it? So as a leader, you think about how can fraud be prevented. Anyone? I'm not asking any technical question. No, general thing. Okay. Okay. I got an answer in the chat box. It says by reviewing the books to avoid any error, or also fraud occurs when there is a third party. There's help taken from third party. Okay. See, as part of the internal control system, one important aspect what we have mentioned was about information and communication. So all the possible information relating to the fraud happening of the fraud, or what possible ways in which a risk can occur on account of fraud, should be first gathered. It has to be communicated to people in the organization. That's step number one. So a I mean, any kind of an issue which is there with respect to fraud, happening of the fraud, how do they get that? So generally in the organization, there is something called as a risk register maintained. The register will have details about what are the possibilities. At the time of learning about risk management, which we will be studying little later, there is a topic called as risk management, how the risk management strategies are taken up in the organization, that we will be studying after a while. So there is a risk register which is maintained, which has the details about what possible risks are can happen in the organization, or so some details would be there. So some kind of information based on past experiences or general awareness about that industry, and so that would be available to provide some information. So the people in the organization are made aware of what possibly can happen, and what is that they should not be involved with. So there is some amount of awareness created for the people in the organization. They have to make it clear about the anti-fraud culture. So what is the value system in the organization, what is that they believe in, what is appropriate, what is acceptable. So that has to be made known to the employees or people in the organization. So have an anti-fraud culture, such kind of a system, um, and the value system what they believe in. So anything related to that about the policies and procedures which they are supposed to frame for the organization, all those measures have to be taken up and inform, or communicate that to the people in the organization. Just because of somebody is taking these measures, inform them about the anti fraud culture or the possible risks that could happen, making them aware about that, it will not 100% prevent the frauds from happening. Some or the, because that's the human nature. Some way or the other, sometime or the other, there is they are prone to get tempted and be involved in fraud. So then, if somebody is involved in fraud, see, all of that cannot happen completely in secrecy. So there's some information others in the organization, if not the top management, maybe at other levels of management, some kind of information can be gathered by people in the organization. They may sense that some fraud is happening, then that could be given as a feedback. So when feedbacks are given, the first important thing, or the factor which stops them from sharing the feedback is um, I mean, their identity being revealed. So would not want the identity to be revealed. So there is a concept called as whistleblowing. So anyone knows what is whistleblowing? It basically talks about, anyone to share what is whistleblowing? Whistleblowing talks about gathering the feedback, not letting the identity of the person who's sharing the details be um, revealed in any case. So maybe some kind of hotlines can be arranged where they can share the information, share the details about the fraud happening. Okay, so no one would get to know about who has complained or who has brought that into notice, etc. So that's the concept of whistleblowing. Whistleblowing is um, gather the information, but the identity can be, um, I mean, not necessary it is disclosed. So it is not disclosed without disclosing the identity of the individual collecting the feedback. Have a sound internal control system which is very effective to identify. So we did study about the components. So thoroughly the internal environment should be studied. They calculate all the risk is calculated. Second component is risk assessment. How to calculate? So have an idea about what are the possible risks that can happen, or what are the different events that can happen internally, externally. So understand about that, the impact of these events on the organization, calculate it in the form of monetary loss, and then finally calculate the value of risk. So um, that's the second component. Third component says that have proper control activities taken up in the organization. Ensure that no fraudulent behavior happens in the organization. Then gather all that information, communicate it to them, and then constantly keep monitoring about how things are happening at the organization. So if an effective, if a sound internal control system is installed in an organization, that itself will take care of preventing fraud happening in the organization. So that's the first aspect of it, is which is fraud prevention. Okay, so in spite of taking prevention measures, still there is every possibility that fraud may happen in the organization. So when fraud happens, while it is happening, or in that process, uh, it should also be become possible to detect it. Okay, that's the second thing, detection. Most frauds are discovered accidentally or as a result of information received, that is whistleblowing. So frauds are identified because of accidentally or intentionally someone shares that information. Okay, same methods of discovering fraud. Some methods of discovering fraud are, um, see, they can have regular checks taken up, that is stock taking and cash count. Um, then again, it depends on what is frequently performing regular checks or frequently taking up regular checks. Depends on different factors from organization to organization. We can see how frequently do they take up the checks. So uh, count on the number of units of stock that is present in the stores department, count on the cash available in the cash box, etc. Cash transactions are to be verified. Okay. um, Warning signals or fraud risk indicators. So when there are signals about fraud happening in the organization, so how would they know? If there are failures in internal control procedures, lack of information provided to auditors, um, auditors verify, auditors give a fair view about the financial statement. So they they have to be provided with some evidence about the transactions that are recorded in the financial statements. So based on the evidence, they would verify and approve of those transactions. So if they do not provide full information, or some information is missing, that is when it is provided to the auditors, that is an indication that something is not appropriate. If everything was fair going on in the organization, complete set of details would be provided to the auditors. Okay, the external auditors take up the activity of auditing, conducting an audit in the organization. Now, we still have not studied about audit committee. We will be studying about audit committee. So audit committee or the internal audit function, so that will connect the external auditors to the financial statements. But then financial statements can be verified when they have the objective evidence of the transactions. Therefore, all these details, the internal audit function or the audit committee takes up, they connect the auditors to the financial statement. So they act as a bridge. So then if there is some part which is missing, then we can understand that that is a signal, that is a warning that things are not appropriate. Everything should be in place intact, and then a complete set of information has to be provided to the auditors. If they fail to do so, then that can be considered as a signal. Then unusual behavior by individual staff members, if it is observed, then that can be taken as a warning signal. And then if there are accounting difficulties, it's not transparent enough, there are accounting difficulties, that also should be taken as a warning signal about some fraud happening in the organization. Already I did explain to you about what's the concept of whistleblowers. So from time to time, gather information from the whistleblowers, or have a effective system wherein people have confidence in that, and then openly they come and share their feedback on the through this system, whistleblowing system. So they become whistleblowers, by which any kind of fraud happening in the organization can be brought to the notice of the management. Okay. First thing is prevention. Second thing is detection. First, take all possible measures to ensure that fraud does not happen. Second thing is, as things are happening, it should be detected, maybe because of uh, um, accidentally, or because intentionally someone shares the information, or if they identify the certain signals, warning signals that are given, based on that it should be sensed that there is something inappropriate going in the organization. That's how fraud is detected. Then we see fraud response. See, after the fraud is detected, what is the response of the management? See, when something wrong has happened, how do they respond? How do they react to that? Is the response. See, the fraud response plan sets out the arrangements for dealing with suspected cases of fraud, theft, or corruption. So then, in that case, okay, procedure for evidence gathering that will enable decision making, that will subsequently be admissible in any legal action. So based on that, they have to prepare. I mean, the system has to have something wherein they would take measures to ensure that such a thing will not happen again in future. Okay, so first they would see that procedures for evidence gathering. Based on this evidence, okay, that will enable decision making subsequently be admissible in any kind of legal action. So they can frame something, they can decide about what course of action would be taken up based on detecting the fraud. Deterrence. See, a deterrent value. What is deterrence? A deterrent value can help to restrict. So ensure that such a thing, the action that they take will ensure that such a thing will not be repeated again in future. So response is, if they are okay, if they are not very serious about when fraud is detected, then people who are involved in fraud will gain confidence to do it one more time. But once it is detected, if the management um, response is about fraud deterrence, ensure that they take a legal action, and which will prevent such a thing from happening. So they include that into their internal control system, the procedure of how to deal with uh, a situation where fraud was detected. So a deterrent value, and can help to restrict damage and minimize losses to the organization. See, the organization's response to fraud may include internal disciplinary action in accordance with personnel policies, civil litigation for the recovery of loss, or criminal prosecution through the police. So any of these measures can be taken up as a response. If they don't respond, if they don't react, things will be the same, it will continue in the same manner and no improvement would be there. But there should be a serious response to that. So internally, their policies and procedures have the consequences if someone is found guilty of being involved in a fraud. If there are policies and procedures, act according to that. So decide what should happen next. Some kind of civil litigation can be taken up to recover any kind of a loss that was identified, or prosecute them based on the criminal procedures. Whenever we study about internal control, we along with that also study about internal audit. See, because audit will help to identify anything which is inappropriate. So the control system is handling about to ensure that the frauds do not happen. Audit helps internal control system. Audit identifies what is not appropriate. By the nature of work, audit internal audit is taken up. The nature of work of the internal audit helps in identifying that, and it helps internal control system. So whenever we study internal control, we also do touch on the internal audit. Okay. So some of you might, maybe you have a paper called as auditing in your BCom course, or otherwise you have already studied about audit and assurance. So I don't think this is a new thing. You already know about what is the audit and compliance. Um, what are the roles of internal audit department? Reviewing accounting and internal control system to ensure that see, the internal control system which is installed in an organization will be looking into the control system in the organization in terms of identifying any fraud happening and to ensure that fraud does not happen in the organization. They look into whether the operations are carried out effectively, smoothly. The second area is about the financial statements, how they are prepared and reported. The third area is whether they comply with the rules and regulations. So the system looks into these areas. But when things keep changing, sometimes the internal control system may not be able to manage all those changes, uh, may no longer be effective in terms of dealing with the risk. So the internal control system also has to be updated from time to time. That's very important. So there should be a verification that has to happen, or someone has to. So the concerned signing authority will be looking into its effectiveness, whether it is able to identify the risk and eliminate the risk. So the internal control system has to be verified and, if needed, updated. So before the financial uh, reporting happens, before that, within 19 days, 90, it has to be verified, reviewed and signed, validated by a signing officer. So reviewing accounting and internal control system. So it is now the responsibility of the internal audit department to review the internal control system. That's one thing. It assists with the identification of significant risk. So internal audit is helpful. It is helping internal control system. See, whatever are the tasks of the internal control system, internal audit helps the internal control system. So it assists with the identification of significant risk, then reviewing the economy, efficiency and effectiveness of operations. Did I ever, I don't remember, did I ever talk about value for money, economy, efficiency, effectiveness? Please say yes or no. I don't remember whether I did teach you or not. Are you aware of what is value for money? You say yes, no, that is sufficient. I won't ask you a question also. But if you say no, then I will have to teach that in detail. That's the purpose behind me asking that question. Value for money. As simple as yes, no is also sufficient for me. Okay, you are aware of that. Okay, good. Um, See, when there is an internal audit department, it is not mandatory that there should be an internal audit function or internal audit department. See, it is voluntarily taken up. Why? See, if something which is not mandatory and yet it is there in place, it is for some benefit. Okay. Um, the benefit is to assist internal control. Anyway, we've looked into that. But whether an internal audit function is required or not also has to be verified. So the function of internal audit department is to check about the value for money. See, any activity that is taken up, does it provide value for money? Value for money, generally we study this concept in terms of not for profit organization. As someone said, yes, you know that, so definitely you should be knowing about that. There are three E's under value for money. It talks about economy, efficiency, and effectiveness of operations. See, if it is economy is about whether measures are taken in terms of minimizing the cost control, whether that has happened or not. It looks into um, uh, measures about cutting down on the cost. As much input as is introduced, are they getting the output accordingly? Is about verifying the efficiency. So there is a comparison about what's the input introduced and what's the output generated. Finally, we see that with the help of economy and efficiency, is the organization effective enough in terms of achieving their overall objective, that is effectiveness. So cost control, input output analysis, plus the overall achievement of the organizational objectives. So it also reviews the concept of value for money in terms of whether they are able to minimize on the cost, get the cost benefit analysis. The benefits are according to the amount of cost that is incurred. Then we see that there is effectiveness in terms of achieving the overall objective of the organization. Then the role of internal audit department, it examines the examining financial and operating information. So the internal control system, when we have studied, at that time we have defined that it looks into the operational efficiency. The active operations are carried out effectively carried on in the organization. One area, so there is efficiency and effectiveness of the operation. So now internal audit department examines the financial information, examines how the operations are carried out in the organization. So it examines the information related to financial aspects, the operating aspects. If at all, if there is any special investigation required, it also helps in that. Then reviewing that. The third aspect of internal control, see, first is operations, second is financial statements, third is compliance with the rules and regulations. So review whether there was compliance from the organization side, whether they have complied with the rules and regulations. So reviewing compliance with laws and other external regulations. What factors affect the need for internal audit? The internal audit, as we have discussed, it is not mandatory to have internal audit function, internal audit committee department. It is for the internal benefit. Okay. So factors affecting need for internal audit, it depends on the scale, diversity, complexity of the company's activities. Size is small, not, I mean, it's a simple set of activities are carried on. It is not complex in nature, etc. There's no need to have an internal audit function at all uh, to take place in an organization. But if the size is big, they are into diversified activities, the organization structure is a complex structure, then in that case, see, to manage with all the activities, it would be required to have an internal audit function, internal audit department in the organization. So the whether there is need or not is dependent on scale, diversity, and complexity. How many employees are there? The number of employees. What's the cost benefit analysis? So having an internal audit committee or a function is costly because there are costs incurred. The benefit that is derived out of having an internal audit function should always exceed the cost. The cost benefit analysis should be taken up. So let's say if the cost is high, the benefits are very minimum. There's no point having an internal audit function in the organization because see the benefits are not much. So it's better that they do not have internal audit function at the organization level, because there are many organizational structures, changes in the organizational structures. Maybe at that point of time, internal audit is required. If there are any changes in key risks, if there are problems with existing internal control systems, okay, then in that case, internal audit function will support the control system. Or because of some recent events that have happened, um, then they can also think of having an internal audit function in the organization. Maybe the recent events have an impact on the organization. They get affected because of the changes and the events that have happened. So I think at that time, there can be a need felt to have an internal audit function. Now we see that auditor independence. Someone who verifies the financial statements and gives a fair view should always have an independent approach. Should have an independent review taken up. Potential risk if auditors are not independent. See, audit function is there to identify any fraudulent behavior. But if auditors do not have that independent view, they do not take up an independent review of what happens in the organization, then there is risk present. Auditors are supposed to review the finance statement independently with an independent view. If they fail to do so, what risks are present? Then, in general, we understand that if the auditors do not have that independence, they would not be able to control the breaches, fail to report control breaches, back down on matters of principle, turn a blind eye to unethical practices, ignore discrepancies, accept explanations without checking, give unobserved positive feedback. So these are the potential risks that are present if the auditors do not have an independent view. Independent, they there is no fairness in the way they take up the work. So what risks are present? Maybe they will not be able to um, control the breaches. Someone not following the policies and procedures, the principles of the organization, that would be a breach in control. Then they just back down on matters of principle. Matters of principle, the ethical principle says that they should have a fairness in the way they carry on the work. Confidentiality has to be maintained. They should have an objectivity that is not being biased in at times when decisions have to be taken up. Then um, integrity, doing what is right. So there are principles to govern about their ethical values. So if they back down on matters of principle, I think frauds cannot be prevented. If they turn a blind eye to unethical practices, anybody is involved in any kind of unethical practice, they do not respond to that. They just turn a blind eye. They just ignore any kind of discrepancies, what ought to be done and then what is happening. If they do not take it very seriously, accept explanations without checking, give unobserved positive feedback. See, a topic like this, when the content is there in front of us, we feel that this is all general. We do know that. Close the book for a while, try to recollect about what could be the potential risk. If you can think about two, three, something like that, if you cannot think about anything, then there is a serious need for you to study from the study text. It may look very simple, it may look very general, but it is not about what we feel when we look at the slide, but it is about when we do not look at the slide, how much are we able to recollect and reproduce. So that is what is the key there. So some topics are quite deceptive. We feel that we know these topics. So, but given a topic, given a case study, and you're asked to write that, things would be blank. So the topics which we feel that they are general, which are simple, easy, um, we need not memorize them, but then once or twice we have to give a reading. While you are reading from the material, these points register in the mind with an impression that we will be able to produce the same content in the examination, because that's so generic in nature. That is um, the a risky thing. It is a deceptive way in which things would happen. So we assume that we can write, but we cannot write. Believe me, we cannot write. Therefore, it is important that we give a reading, very serious reading. You don't have to memorize anything, okay? But while you are reading, some amount of some content will get registered in your mind, and then you will be able to reproduce something and write it in the examination. So please do consider that part. What are the threats to auditor independence? Threats to auditor independence. First, we see self-interest. Auditor could benefit from financial interest in client. Okay, that's the major thing. That's the main reason why there is a threat to auditor independence. Why is that the auditor would not give an independent view of what is happening? First thing is there's some financial benefit associated with the way in which he responds. So if he's benefited out of that, then I think he will not have that independent view at all. Okay, that's one thing, one danger that is present, which can affect the independence of internal auditor. The next one is advocacy. Auditor promotes an audit client's position or opinion. Advocacy. So what does it mean? recommendation, advocacy, we can take that to be as a recommendation. When they are promoting, auditor promotes an audit client's position or opinion, that is referred to as advocacy. So that is another threat to auditor independence. In fact, actually, the auditor cannot have do any favors to the client. They should have that independent view and then give their opinion about whatever is the situation in the organization. That they have to have that independent view. But here, without looking into what is going on in the organization, if they promote an client audit client's position or opinion, that is a threat to auditor independence. What's the meaning of intimidation? Any one of you? Would you tell me what is before that? Why do you think that the auditor promote someone? What could be the reason why they would promote them? Any reason? Any reason why the auditor promotes his or their clients? What do you think? Why would they do so? You don't know, you nobody knows. Generally think and tell what is the need? Why would the auditor promote the client? Somebody right don't know. I will have an assurance that somebody is listening to me. 100 odd students are there. You don't know the answer. Generally think and tell me. Economic benefits. Um, see, one of the points what SOX has mentioned. I don't know whether yesterday we've learned. See, one of the points what SOX mentioned. I will just quickly look into that and then we'll come back to this point. It says that auditors are restricted in the additional services they can provide to an audit client. Suppose there is a firm providing audit services. The same firm should be restricted from providing any other type of services. So other type of services could be like maybe they are filing their tax returns or some kind of other types of work which can be carried out. So that is outsourced to the auditor. Auditors may have some of the firms are quite big with the multiple services that they provide to their clients. So a firm which is providing audit services should not be allowed to take up any other type of services. So if they are providing any other type of services, they would be generating some revenue out of that. So the auditor will now be biased, because if anything which is not appropriate with the client, if it is identified, it would affect his business. So That's one important reason. For that reason, the auditor may not give an independent view, will not give a fair view about what is happening with the organization. So, okay, that's the reason why the auditors promote their audit clients in spite of knowing that something is not appropriate with their clients. In spite of that, they continue to promote. And when that happens, see the fraud that is happening within the organization, it will continue to be there, and then it also may grow in size. So ultimately a day comes when everything will collapse. So that is the threat what is there. So threat to independence when the auditors are promoting the audit clients. Okay, that's one thing. Intimidation. Anyone knows what's the meaning of intimidation? Auditor is subjected to intimidation. Anyone knows what's the meaning of intimidation? Maybe threatened. So when the auditor is threatened, maybe he's worried, he has that fear of some action taken against him, or that intimidation. When he's subjected to intimidation, that fear thought or worry that some damage can happen to him if he gives a fair view. So that is about intimidation. Okay, then we have familiarity, then we have self review. Familiarity, see, self review is auditor is in position of reviewing work they have been responsible for. Self review. The auditor in position of reviewing work they have been responsible for so the work that is assigned to them. Sorry, I so we are here about the last 2 points, the threats to auditor independence. One is self review, the other one is familiarity. Auditor in position is position of reviewing the work they have been responsible for. So, in some capacity, the auditor is connected with the organization. The, as part of giving his independent view, it may include the auditor also, because the auditor was connected with the organization. So it would be about reviewing his personal work also. So maybe his personal work would be highlighted, and then he will become responsible for that. So to avoid that, the auditor may not give a fair view. So that is self review. If the auditor was involved with any work, by giving a fair view, he may come into light, and then he will become responsible because the work was not carried on appropriately, or some way he wants to avoid he becoming responsible. Therefore, it can affect the independence of the auditor. Familiarity, we know that familiarity concept is auditor becomes too friendly with client for working for client for a number of years. So for a very long period of time, the concept of conformity, because they feel that yes, whatever is happening in the organization, since we know them for a very long time, therefore everything would be appropriate. Having that kind of an attitude is familiar. So now we've come to audit committee. How many committees did we learn till now? Till now, how many committees did we learn? This is which committee which we are going to learn now? Can you mention which are the committees which we have learned? Any one of you? At least one. What committees did we learn? Nobody knows what committees we've learned. Did we learn nomination committee? Did we learn remuneration committee? Yes, no. Am I audible? How many still we have to learn? What we learned only you don't know. What else do we have to learn? From where will you tell me? Just a second. Huh. What are the committees we have learned? We finished learning about the nomination committee, somebody who looks into the appointment of executive directors and the non-executive directors, what kind of directors should be appointed. They look into the details about taking them the pay, the position which which has to be assigned from diversified areas and all. So these people have to be taken into the organization. So what is the responsibility? It is basically about nominating executives on the board of directors. So someone coming from diversified, please see the roles, responsibilities of the executives, and what is the role of CEO, chairman, etc. Then everything about nominating directors on the board, the executive directors on the board. Remuneration committee is the second committee we have learned. So the next one, what we've learned was about remuneration committee. What do they do? As self-explanatory, they look into what should be the remuneration of these people on the board. So the roles and responsibility recommend and monitors of the pay package, the incentives, the clarity in terms of when can they avail incentives, etc. Any kind of compensation for loss of office of any executive director, anything to do with the remuneration part of it. Okay, so two committees we have learned. So now we are looking into the audit committee. We still have not done about risk committee. So the third committee, what we are learning now is about audit committee, because we are doing internal audit. Okay, so now audit committee. The audit committee is a committee of the board of directors consisting entirely of independent NEDs. Entirely of independent non-executive directors. In a large company, at least three should be there, of whom at least one has had recent and relevant financial experience. So one person should be a financial expert. At least one person should be a financial expert, because when the audit work is taken up, um, they have to have that financial knowledge about it. So at least one has had recent and relevant financial experience. The audit committee's key function is to provide evidence of how increased accountability um, to stakeholders. Critical that the audit committee be independent, comprised of NEDs, and has written terms of reference. The rules of audit committee: review of internal control system. I have already explained it 2-3 times. So you know that the role of the audit function in audit committee is to review and validate the efficiency, the effectiveness of an internal control system. So they have to look into that. If it is not effective enough to identify this, then I think it has to be updated. Okay. Then monitor integrity of financial statements. That's the second thing. uh, verify the financial statements, maybe compare them with the if they have to verify that with the evidences that are present, and monitor integrity of financial statements, oversee work of internal audit. Okay, what's internal audit? Your internal audit is someone, uh, it's a function within the organization to help the audit function or the audit work to be carried on smoothly. So they have to provide all that required by the audit committee. Okay, so they are there to help the audit work to happen. So they also have to oversee the work of internal audit, how it is being carried on. Then review work of external audit. So the external auditors who are appointed to carry out with the work, they also have to review the work of external audit. So what are that those are the roles of audit committee. So reviewing the audit committee internal control, review the company's internal financial control. Basically, whether the internal control system is effective enough to manage the risk. Okay, give approval to internal control and risk management statements in annual report. Receive reports from management about effectiveness of the control. Receive reports and tests carried out to on controls by internal auditors. See, the audit committee that is appointed, which has exclusively uh, NEDs, non entirely NEDs in the committee. Of these NEDs, one should be at least be a at least one should be financial expert. Now, their work is to look into these areas: internal control system, integrity of financial statements, review work of external audit, internal audit. So, what so this is about internal control. How do they review the internal audit? Audit committee role is overseeing internal audit function, ensure accountable to the audit committee, monitor and assess effectiveness, review and assess the annual internal audit work plan, approve the appointment of termination of head of internal audit, preserve independence, check efficiency, ensure recommendations are action. J. Naveen Richard, please respond to me. Naveen Richard, respond to me. Say yes or something. Naveen Richard, J. Naveen Richard. This is the last time I'm admitting you into the class, because every 10-15 minutes you log out of the classroom, then you again come back in to the class. I don't know what fun you are having. The next time you are out of the class, you be out only. Don't ever come back. Once in a while, if it gets disturbed, I can still understand that. But how is it possible every day, every 15 minutes you are out of the classroom and then you again come back into the classroom? Okay, what's the audit? What are audit committee's duties in terms of external audit? Recommendations on appointment, reappointment, and removal of auditors. Oversee selection process. Approve terms of engagement and remuneration. When the external audit happens, who should be appointed? Basically, their terms and conditions, remuneration. They ensure that the independence and objectivity of the auditors is there. then review scope of audit, ensure appropriate plans at start of audit, and carry out post completion audit review. Okay. See, generally, when the audit work is done, it need not be taken as the work is completed, but it has to be looked into about any work. Uh, it is not sufficient that the work is completed and then close that. After the work is completed, it has to be looked into. There should be a post completion audit has to happen. Whether the work was effectively completed. It's just not enough to understand that the work is completed, but look into what actually happened. Did they achieve what they intended to achieve? So there should always be a post completion or review to take place, either in audit work or investment into some project. See, if the project work is completed, that is not sufficient. But later on, also it has to be looked into about how the um, work was completed. Maybe there's any better way to do that. So the last thing is about post completion audit review also has to happen. We'll go for a break because the next thing is about risk identification, assessment, and measurement of risk. That's chapter 15. So we will be studying in detail extensively about risk management, right from the time to understand what is the meaning of risk, the process of managing the risk. There's a concept, there is a framework called as ERM, Enterprise Risk Management. See, that is an elaborated form of what framework yesterday we've learned about internal control. So that one also we will be looking into here as enterprise risk management. Then certain other aspects about risk and models about risk we will be learning. So completely about risk is what we will be looking into post break. Okay. Um, till when do we have our classes? No, but as soon as we finish the content, we will touch upon certain case studies. So when can I come? Saturday we have two sessions. No, I will do case studies also along with the content. I will do case studies also. Okay, go for a break. Join back at 10:30. The next chapter here is identification, assessment, and measurement of risk. So we will be looking into what's the meaning definition of risk. Okay, then how risk is identified, and then assessment of risk. So everything to do with risk, and basically the risk management part of it we will be looking into. How do we define what is risk? Okay, so there's a definition given here. Risk can be defined as an unrealized future loss arising from a present action or inaction. So how do we understand this one? Unrealized future loss arising from a present action or inaction. See, but the future is anticipated, future is expected. So when future is anticipated, um, it's expected that something would happen. But if there is a variation in what would happen, on account of that, the possible loss that can happen, it is unrealized. It is only while estimating itself, it is known that there is a possibility of some variation to happen in the future. So this can be defined as an unrealized future loss arising from the present action or inaction. So If they anticipate that there would be some variation, either they take some measure or they do not take measure also. If anything that might happen in the future, so some anticipation about a variation from the expected thing to happen in the future can be referred to as risk. Is defined in many ways. See, this is one way of presenting it here. Some say that it is just that there is some amount of variation from the expected one. Some say that it is a financial loss, it's a monetary loss that happens because of variation. Okay, here it is presented in this particular context, it is presented as it is an unrealized future loss arising from a present action or inaction. Risks are the opportunities and dangers associated with an uncertain future event. So with certainty, it is not possible to expect what would happen in the future, anticipate what would happen very precisely, very surely, with certainty. It cannot be estimated. Future itself is uncertain. So what will happen in the future is not known. So any kind of a plan that is prepared for the future to happen it exactly the same way is not a possibility. So risks are the opportunities and dangers associated with the uncertain future events. Uncertain because so because of this uncertain future events, anything, any variation that happens. What's the problem, Jeremy? Some problem is there? Can be referred to as risk. Okay, risk, we need not always think about risk in a negative sense. Risk is not always a loss. Okay, though some refer to that as a negative impact or some loss to happen. It's not necessary. It is always on the downside. It's not always on the negative side. Let's say that. For example, if they anticipate that in future they would be able to sell some 50,000 units. So this is the expectation. This is the plan. The plan is to sell 50,000 units. But maybe it's because some reason, some events happening of certain events, finally they may end up selling 60,000 units. So that's more. So this is a variation. Anticipation was only 50, but in reality they have ended up doing more business. The demand was more. They ended up selling more number of units. So we see that there is a variation, but this variation is a positive variation. So risk should not always be looked at as an adverse thing. It's not always a negative thing. It could also be positive. The only fact that there is a variation is referred to as risk. With some kind of uncertainty, there's some kind of variation from what is anticipated, from what is expected. That is referred to as risk. So risk could be both downside, both upside, and also upside. So unfavorable or favorable. Okay. Going with the view that risk is um, uncertain and that there is a negative impact. Should risk be taken up? That's the next question. Why incur risk? Any one of you, do you have an opinion about that? Should risk be taken up or it should be avoided? Okay, I'll put it this way. See, if someone invests in stock market, okay, it is risky. See, um, general public also, they know, in general it is an opinion that investing in a stock market is risky. So does it mean to say that people should stop investing in stock market? Any investment opportunity which has risk should be completely avoided? Should that be the case? Any one of you investing in stock market? These days students are also very actively trading on the stock market, even if it is in small.
Ma'am, I am interested.
So what attracts you to invest into the stock market? Very good, good response. What attracted you to take up this? What was the factor which convinced you to take it up?
Yes, ma'am.
What, Jeremy?
Ma'am, the thing that attracted me is the scope of making money.
Scope of making money. Why not some other source? Money is available in many other uh, avenues. I am not recommending, or I'm not opposing that. I'm just wanting to get some information out of that. So you're a student and you have you're attracted to investing into a into stock market. So into the stocks, you purchase and trade with the stocks, etc. So the answer what you have given is about making money. Okay, money is available in other ways also. Okay, nothing about degrading it. I'm just collecting the opinion. Anyone else? Not, it's not only one student should be answering. Why do you think that people do take up investing into stock market? Okay. Easy returns, it is not. I mean, answer is correct. Better returns when returns are there. More money when money can be earned. See, risk is there of losing the money, but when they earn money, better money. The returns are very attractive. Okay, when there are profits earned, when there are returns earned from that, that's nothing in comparison to I mean, that's far above than any other conventional work which is taken up. See, on an comparative basis, if we can talk about investing in a bank also is an option. Okay, we hardly get any return out of that, because see, that is the way in which the investment into banks are taken up. See, if it is invested into stock market, very soon the returns are earned. But each of them have their own aspect about it. See, investing in a stock market, the interesting factor is about earning easy returns or better returns, what we call it as better returns than compared to investing into a conventional investment opportunity like a bank. But the aspect of it is, the bank, the risk is absolutely not there, or almost not there. Um, the investment amount would be safe any day. They can always have back their get back their investment amount. Stock market is not so. When it is affected adversely, when there is a negative impact, there is a risk of even losing the investment amount. Okay, so there we see that there is a relationship between risk and return. If the risk is high, the returns are also high. High risk of even foregoing their investment amount. This is just one example what we have taken. If the risk is high, the return is high. So the possibility of earning better returns is one important reason why people take up risk. Why incur risk is one important reason is risk is directly related to or there is a direct relationship with return. If the risk is high, returns are high. So the motivating factor behind taking up risk is to earn better returns. If the another reason is, if something which has in risk involved, if it is taken up, then that would put them um, far above their competitors. They can gain a competitive advantage. Until that point of time, what others have not tried, if some business tries that and gets some benefit out of that, that will make them a leader in that particular area, because they are the ones who have taken the initiative to gain competitive advantage. People get interested or attracted to take risk. So why encourage? To gain competitive advantage. Okay, so they can be a leader in that particular aspect, um, and enjoy benefits out of that competitive advantage. Second one is to earn better returns, increase financial returns. Okay, that is why risk is incurred. What is risk management process? So risk management process, um, if there is risk, say risk, okay. Risk refers to some amount of uncertainty or volatility or variation is in what is anticipated to happen and what would happen. So some amount of variation can be referred to as risk. Then these things have to be managed. So risk management process, a process which manages the risk so that the impact which is there can be minimized. So the process has these steps. First step is risk identification. The second step is risk analysis, analyze the risk. Third one is about risk planning. And the last one is about risk monitoring. Step number one, risk identification. How to identify risk? See, wherever risks are, whenever uh, risks happen or risks occur, in the organization, we have something called as a risk register maintained. A risk register will have all the possible risks that can happen in an organization, or those risks that can affect the organization. The details of it are recorded in a risk register. So that can be considered as a database related to the risk. So the list of potential risks that are possible to happen. So risk can happen internally. Internally, there could be accounting mistakes, errors, frauds. Internally, there could be embezzlement. Things can be stolen. Intentionally, they can misuse the assets of the organization. See, internally, there can be um, employees not cooperating. So we see that different ways in which the management could be inefficient, not taking appropriate decisions. So these are all possibilities that can happen in the internal environment. Externally, government changes the rules and regulations, non-cooperation from the suppliers, customers expectations change, there are expectations from environmentalists. So many stakeholders are there in the external environment. The investors not extending additional capital, the multiple things that are there. Some of the risks are very specific to the type of industry. Okay, so there is a risk register that is maintained which has all the details about the possible risk that can happen. So of late we also see that there are certain softwares that are available which give the details about the possible types of risk that can affect a business in a particular industry. So every there are certain such kind of databases available from which it can be looked into what are the different types of risks. So first step number one talks about identification of risk. What possible risk can happen that can affect the organization? Risk identification, list of potential risks. After that, see, there are multiple risks. Now these risks have to be managed. So when they have to be managed, there are multiple risks. If there was only one risk focus on concentration would be on that risk, and then it would be managed. But if there are multiple risks, then they have to be prioritized. Which one has to be given importance? Prioritize these risks, and then therefore um, take up that risk and manage that risk. So prioritize the risk and respond to the risk in terms of managing that risk. So risk, the second step is risk analysis, prioritize them and take up the course of action. Next step is risk planning. Okay, risk planning, we will be studying about a framework called as TARA framework, transfer, accept, reduce, and avoid. So, what should be the strategy when risks are managed? Risks are this planning about risk and then managing the risk. So, there is a framework. Little later, we will be learning about that framework. So, wherever it is needed to avoid, risks are avoided, and some contingency plans should be taken up in place of those events. Okay, so planning for the risk in terms of avoiding or in terms of taking up an alternate course of action, risk avoidance and contingency plans. Next we see that risk monitoring, the last step. As they have plans in place to deal with the risk, when that is implemented, so monitor that or assessment of the risk. Okay, these are the stages or steps in the risk management process. Yesterday, we did learn about COSO's framework of internal control. So, COSO has given another framework called as enterprise risk management. Okay, what is the definition of enterprise risk management? The this committee of sponsoring organization, COSO, what we call it as COSO, in 2003 has come out with a concept called as ERM, enterprise risk management. We'll see first what is the definition of ERM, enterprise risk management. It says ERM is a process. Who all are involved in this process? See, enterprise risk management. In terms of managing the risk, there is a concept called as ERM, enterprise risk management. What does it mean by ERM? It says it is a process. In this process, who all are involved? See, the people who are involved are from all levels of management. Affected by an entities, we see board of directors, we see management and other personnel. So from every level of management, people are part of this process. ERM is a process affected by the entities, different levels of management, people from different levels of management. What is that they are all involved in this? See, applied in, they are involved in the areas where they, the role of ERM is seen is in strategy setting, and across the enterprise, designed to identify potential events. So it's in every area of the organization. ERM would be identifying, this process will be identifying the potential events that can affect the business, that may affect the entity, and manage risk to be within its risk appetite. What is appetite? Risk appetite. Within its risk appetite, to provide reasonable assurance that the objectives of the organization would be achieved. Ultimate goal, see, any risk management process, when we talk about, ultimate aim is to ensure that the organizational objectives are achieved. But in between, when we see that organizational objectives are not achieved, in that case, why is that it is not achieved? Because of happening of certain risky events, certain events that can cause risk to the business. It is not possible to achieve the organizational objectives. So therefore, there is a process that is involved in identifying what are the potential risks that can happen, manage them effectively, so that ultimately they would be able to achieve the organizational objective. So this ERM, the concept of it is introduced by COSO. This is a framework which says that it is a process involving people from all levels of management, in terms of see, they would be looking into what is the strategy that is set, and in different other areas of the organization. Okay, then they would be, or the process would be looking into identifying the potential risk and the impact that these events can have on the organization, ultimately to ensure that the organizational objectives are achieved. Okay, definition wise it looks so very big, but when we split that, it is not such a difficult thing, it is easy to understand. Now, what are the principles of ERM? Principles of ERM: risk management in the context of business strategy. Risk management, it says that it is everyone's responsibility. That's why we see that people from all levels of management are part of this process. But yeah, the other day also I did mention to you that anything to be effectively implemented, the tone is always set at the top. If there is seriousness with the top management, everything can be effectively implemented. If they are not serious about anything, if um, they are I mean not very particular about implementing things effectively, it cannot be implemented. See, even people at the other levels of management, they are interested, they are serious about it also, it cannot be effectively implemented because the top management are not serious about it. So for everything, anything, we see that the top management has to be serious. The tone is always set at the top. With the tone set from the top, the okay, the in every be I mean here, the process in which everyone has to be, people from every level of management would be involved, but the seriousness is always at the top. Okay, then to create a risk aware culture, making them be aware of what are the possible potential risks that can happen, make them aware of that. Then a comprehensive and holistic approach to risk management, consideration of a broad range of risks, that is risk at strategic, financial, operational, and compliance. So looking into a broad range of risks, a focused risk management strategy led by the board. So embedding the risk management, embedment of internal control into the activities of the organization is what we've learned. Now, if there is a risk management in process, that also has to be embedded. It should not be looked into as a separate process, but they have to make it as a part of their activities, organizational activities. So embedding the risk management process into the regular activities of the organization. A focused risk management strategy. So yesterday I did show you one framework for internal control. Yes. How do you know Navin is there in waiting room? That's right. Yes, I do know that. Where are you all? At home or at college? One second, I'm just opening the courses framework. Yesterday, I did show you just to draw a similarity between. I mean, what is this concept about? See, the COSO has given the framework for internal control. Okay, so internal control framework has 5 components. The first component is control environment. The second one is about the risk assessment, calculation of risk. We have control activities. Then we see information and communication, and then last one is monitoring. Morning also we discussed about these 5 components. Later on, COSO has come out with another framework called as um, enterprise risk management. So when you see that these are the 5 components, to draw similarities, I'm just comparing both of them. See, the 3 major areas where internal control will be applied is one thing we see it is about the effectiveness and efficiency of operations, efficiency, effectiveness of operations. Financial reporting will be appropriate without any misleading information, misrepresentation. Financial reporting will be done in a fair manner. Then that they would comply with rules and regulations applicable at all levels of the organization, at the entity level, division level, operating units level, or at the functional level. Okay, I don't have a color image, it's a black and white image. Nevertheless, just look into that. See, we see that now ERM, the operations reporting compliance, along with that, we see even at the strategic level, the planning that happens at the strategic level also. See, we see strategic operations reporting compliance, even at for internal control also we did look into that. Across the organization is the same thing. Subsidiary, business entities, division, entity level, everything is the same across the organization. This can be implemented, but here these are not 5 components, these are 8 components. Internal environment, then we see objective setting. Third one is event identification. Fourth one is risk assessment. Then fifth is risk response. We see control activities. 7 is information communication monitoring. So what is common there and here? We have the control environment, internal environment. That is the same thing. So this is what we have learned in internal control framework. Then from there, we see risk assessment is the same thing. Control activities, information communication, monitoring are the same. See, with respect to risk part of it, instead of having it as one component called as risk assessment, risk is now split into identifying the events which can cause risk. So risky event identification, calculation of risk, just not about calculation of risk, but in terms of risk, what should be the response? What is the response, or what? How would these risks be dealt with? So risk response. So risk event identification, risk assessment, and risk response. It's kind of split into 3 parts. Technically, there also when we study about how to calculate the risk, we did learn about first events are to be identified, and each event what is the impact that is there. So what is the monetary value of these the happening of the event, the impact of these events, which is quantified as monetary loss. So we just have that separated as event identification, risk assessment. One important thing is, apart from that, what would be the response? So after identifying what is the amount of risk, will it be accepted or will it be avoided? So that is the risk response. So we have a framework in terms of risk response, Thara framework. We will see that also. Now, because there is one area which is added, which is strategic. So in terms of strategy, objective setting, objective, what is the objective that has to be achieved, that is also included. So easy to remember about the framework of internal control and the framework of ERM. Framework of internal control has 5 components. Now these 5 components, one, risk assessment is now looked into from 3 different areas: event identification, calculation of risk. After calculating the risk, what is the response towards risk? Should it be accepted or should it be avoided? There are 2 other things also. Risk can be transferred or risk can be reduced. So that's why it's SARA. Apart from that, the objectives, it is also into, see, where do we see ERM? So the definition says that it is applied in strategy setting also. It is applied in planning. It is applied in um, setting the objectives so that things can be implemented. So it is applied in strategy setting also. So we see setting the objectives, then the rest of it follows. This framework is applicable across the organization. That is ERM. Okay, to look into each component. First one is understand the internal environment. Once again, I will repeat. Yes, morning also I explained to you about that. But what are these components? One last time we will look into that. First, understand the internal environment. What is the organization size structure? Then the board of directors. Then their roles and responsibilities. Then if there is system which is there to control the risk, then what are the policies and procedures? Those things have to be communicated to people in the organization. The attitude of the top management, the abilities of the employees in the organization, the role of board of directors, audit committee, and others in the organization in terms of managing the risk. So first, thoroughly understand about what is the internal environment. After that, what are the objectives? Objective setting. The objectives that have set, see how our objectives set. Class number 1, first class, we've learned about the process, strategic process. Objectives are set based on different types of analysis, internal, external, stakeholder, etc. So what is that has to be achieved, has to be decided, that is decided as objectives. Objective setting. Then comes event identification. What are the events that can cause risk to the business? How do we identify? I did mention to you about a risk register, in which all possible risks that are possible to happen are recorded. The details about those events are recorded, and that can be referred to for reference. Or there are certain softwares available which can talk about the possible events that can happen, which can cause risk. So events have to be identified. Events can happen internally, externally. After events are identified, then assessment of the risk. Assessment of the risk is calculated. So how is risk calculated? So the quantification of risk, the risk is equal to, there are 2 things which are to be looked into. The impact. What is this impact? Impact which these events have on the organization. So the happening of the event itself is not risk, but the event, what impact it has on the organization, should be quantified. And impact, and the second variable is the likeliness of such a thing happening also has to be taken. The percentage chance of the happening of this event, We call this to be as probability. That also should be taken up. Okay, impact into probability. Okay, multiply them and calculate the risk. That is risk assessment. After the risk is quantified, after the risk is calculated, next we see what is the response. So response is, we know that it is risky. There are four different responses that can be seen in case of risk. One is, the risk can be avoided. Maybe, see, basically the response is in terms of um, the attitude of the individual or the organization. So what is their attitude? Do they want to take up risk? If they want to take up risk, why take up risk? Just now, few minutes back we've discussed, why take up risk is maybe to increase the financial returns and have a competitive advantage. So they can come forward, take up the risk, accept risk. Or if they are averse to risk, they don't like to take up risk, so they just want to be there in the market, survive in the market, not experiment many things, not think about maximizing the profit, but they want to have their presence felt in the market. If they can make a decent amount of return, they are happy. That's an attitude. Okay, so if that is what is their attitude, they can also think about avoiding the risk. Okay, one is accept, one is avoid. Next is, maybe risk is present there, they do want to take it up, but they do not want to take it up as it is, but take all possible measures to reduce the impact of these events. So risk is reduced. That's another response. Risk reduction is the third response. One more response we have it as, see, if there is a risk that is present, do take it up, but need not face the consequences of the risk. That can be transferred to a third party. But who would be taking it up? So transferring is that if you identify that there is a risk present, that risk is insured. When it is insured, there is an insurance coverage for that. Take it up. See, if it is going to affect the organization, see, then we decide on when to adopt any of these four strategies. Also, there is something there, we will be looking into that. See, then if risk is present, the attitude can also be in terms of transferring the risk to a third party. But then again, it cannot be anybody, cannot, but those that have this coverage of insurance by paying a premium, that is what has to be done, so that the risk can be transferred. So the framework is called as TARA framework: transfer, accept, reduce, avoid. Okay, so that is the risk response. Then next one, sixth one is control activities. Ensure that there are proper control measures taken in terms of restricting the access for various things, or having segregation of duties, ensuring that the assets are safeguarded, etc. So some certain kinds of control activities should be taken up. Okay, then gather all information relevant to the risk, how risk can be effectively managed. Gather all information and communicate that to the people in the organization as they implement the risk management process. Constantly keep monitoring about how things are implemented. Okay, so that's the concept of ERM. I hope I made it clear. What are the benefits of having effective ERM? Benefits of ERM: enhanced decision making by integrating risks, Okay. What are the benefits of effective ERM? The first one says that enhanced decision making by integrating risk, the resultant improvement in investor confidence, focus of management attention on the most significant risk, common language for risk management which is understood throughout the organization, and reduced cost of finance. First thing, if at all, if there is a risk management process in place, risk management, see, um, see, there is a process in place which looks into managing the risk. So if at all, if there is a risk happening, actually happening, because there is preparedness already, they are aware of what are the possible events that can cause risk and how to uh, manage them. If there is a strategy in place, then they would be left with fewer surprises. They would not be surprised if something happens negatively, positively. If there is some amount of variation, there is some amount of risk that occurs, there would be preparedness. Okay, so the decisions that are taken, enhanced decision making by integrating risk. They know about it, they understand that, because the risk management process should not be looked at as a separate process, but it has to be embedded into the system. So they know, they are aware of what would happen and what is the consequence and how to face that. So that preparedness would be there. Feeling surprised would not be there. um, Getting impacted by the risk would not be there, but better management would be there, enhanced decision making. Then if there is a risk management in process, the investors will have their confidence because they know that yes, there is a risk management process in place. Even if they are hit by any negative events also, they still know how to manage with that. Why? Because there is already a process in place. Therefore, investors' confidence will improve. They can focus of management attention on the most significant risks. The risks are prioritized. When there are multiple risks that are happening, the how to deal with these risks, the way in which these risks would be dealt is by prioritizing them. Prioritize the risk. The most um, um, impact, the events that have most impact or the risks that have most impact are dealt first in the order of priority. Risks are taken up for managing them. Okay. Then everybody understands what is risk management process, so it's a common language of risk management which is understood throughout the organization. Last point, I want one of you to, somebody, to throw light on this. Reduced cost of finance. From where are we talking about cost of finance? Reduced cost of finance through effective management of risk. See, to have a risk management process, it involves costs, isn't it? A new system to be to introduce, it involves cost. So what is that we are talking about basically? Reduced cost of finance. I want somebody to respond. Whatever you feel like you can share. No, nothing as such as to what is the right thing, what is the wrong thing. Why would there be reduced? In fact, actually, to have a new process to bring about and then introduce and embedding it into the system, etc., all that in fact requires additional cost. But what are we talking about? Uh, Reduced costs, and this time it is reduced cost of finance. Um, Optimum rate at which the finance can be earned. But how are we connecting it to ERM? The cost of finance, the rate at which they can borrow the finances is one thing, but why would someone extend them funds at a reduced rate? Why would it happen in connection to ERM or in connection to risk management process? The reason is, we already have discussed about the improved investors confidence into this, so therefore there is an assurance among the investors that risk are effectively dealt. Therefore, they are confident about mm, the organization managing the risk. So there is no uncertainty which can be seen. So they are assured of earning a return on that. In terms of shareholders, the shareholders get attracted based on the profitability, so they come forward and invest in the company. So when the I mean, when they exhibit the confidence, then I think their expectations from the company will not increase. If their expectations to earn higher returns will not be there. They know for sure that yes, there are better ways to manage the risk. So they do not put pressure on the company to earn better returns and pay better dividends. So that's one thing. See, like one of the students have mentioned that reduced cost of finance, the investors know that yes, their returns are sure, so they have their confidence, so they extend their funds or investment at lower cost of capital. So expectations from the company in terms of better returns will come down. So when that comes down, higher expectation comes down, then automatically the cost of finance also reduces. This is possible because there is a risk management process in place. When there is a risk management process in place, the see wherever risk is high, the shareholders expect a higher return. That is called as implicit cost. What they want a return is an explicit cost. What they expect the company, see, now satisfying the shareholders is very important for the company. If they are not satisfied, they would withdraw their investment. That will have a negative impact. So to satisfy the shareholders is one of the objectives of the financial management. Now, when the shareholders are confident that risk is effectively managed, then they do not expect a higher return. If they have a higher expectation, to fulfill that higher expectation and paying better dividends is the only way what the company has, that will increase their cost of capital. If it is not so, if the expectation of the shareholders is not very high, then then those things would not be taken up and the cost of capital will be under control. Reduced cost of finance through effective management of risk. I hope I made it clear. Okay. In fact, actually, different category classifications of risk we can see, but whatever comes our way, we will take it up, because the paper is not only about risk management. Risk management is one part of SBL. So whatever is given according to our syllabus, whatever comes our way, we will take it up. But these are not the only types of classification of risk. There are various other ways of classifying various categories of risk which are there. But whatever is there in our syllabus which comes across our way, we will take it up. The paper is not about risk management. One section of strategic business leader is risk management. Why are you to study this one? Tomorrow, when you become a leader in an organization, you should also have a knowledge about how to manage the risk. Therefore, you study. That's why see, the paper has diversified topics, many things. Okay, um, but every topic touches the aspect of decision making. You, as a leader, have to have this information, this knowledge. You should be equipped with this knowledge so that you can become a good manager. You will be able to take better decisions. How to know that? If you pass in the examination, whatever is expected of you to present that in the examination, if you do that, you yourself will prove your worth, and then you will become a leader. May all of you become good leaders by clearing this exam, and then join the organization with required skills and ability to take better decisions. Next, come to strategic and operational risk. One category of risk is risks are categorized as strategic risk, operational risk. Strategic is strategic. See, class number one, first class onwards, we've been studying about the strategy. Strategic risk is the planning at the organization level. The plan that is applicable for the entire organization, strategic planning. So strategic risk. So if there is a risk connected to strategy, strategy is a plan for the organization. Strategic risk is the risk that the strategy of the organization or the plan of the organization will fail. That is the risk. When there is planning that happens, um, which which involves the entire organization, so that's called a strategic plan. The the concept of strategic risk is risk that the plan will not do well. Risk which is at a see, it is just not at the organization level, it could be also at the global level. Okay, so it affects the overall mission of the organization. Why the overall mission of the organization? Because plan which is prepared to ensure that the objective, the mission can be achieved. If there is a possibility of that plan not doing well, that will be about failure of the plan, failure of the plan, not making it possible for the mission to be achieved. That is called as strategic risk. Risk that the strategy of the organization will fail, not allowing the mission of the organization to be achieved, or the objectives of the organization to be achieved, can be referred to as strategic risk. Operational is at the implementation level. Risk that will affect the day-to-day planning, affects the day-to-day activities of the company, is referred to as operational risk. Okay. Strategic risk arising from the possible consequences of strategic decision taken by the organization. Why would it fail? Why would it fail? There are many factors about why would it fail. It could be internal, external, all those things. Possible consequences of strategic decisions taken by the organization also arise from the way an organization is strategically positioned within its environment. So it's just not about inefficiency of implementing that. Sometimes external factors, even at the global level, also we can see that sometimes certain factors do affect the organization, not enabling them to achieve their um, achieve their objectives, not able to implement their strategic plans effectively. The failure can be from internal inefficiency of the management to implement it effectively, or there are factors in the external environment that can affect the organization, because of which the um, things do not happen, um, and then mm, the objectives of the organization cannot be achieved. Also arise from the way that an organization is strategically positioned within its environment. Then we see that should be identified and assessed at senior management and board of directors, because see, the strategic planning, who's involved in the strategic planning? The management at the top management, the senior management, top management, board of directors, they are all involved in strategic planning. So it should be identified and assessed by them, people at the top. What analysis are useful in identifying this is pestle analysis, in the external environment, the political, economic, social, technological, environmental, and legal factors, how these uh, how these factors can affect the organization. Pestle analysis, SWOT analysis, both internal as well as external. So take up these analysis to understand about what are the strategic risks that are present, how they can affect the organization. Next one, operational risk. Operational risk is operational is the implementation. So day-to-day happenings of the organization. It refer to potential losses that might arise in business operations, include risk of fraud or employee malfeasance, poor quality production, or lack of inputs for production can be managed by internal control system. So at the time of implementation, so internally, then we see that it could be about risk of fraud or employee being involved in some kind of embezzlement or fraudulent behavior, stealing things. So employees misbehavior. So risk of fraud or employee malfeasance or poor quality production, too many defective units are produced or lack of inputs for production. So these are internal factors which can affect. So day-to-day implementation, if there is any failure which is seen, is called as operational risk. Then different categories of risk. Conceptually, you should be knowing about what are these risks. Okay. Conceptually, the risks that are present, let's learn them. Shall I give you an assignment here? Very simple. These are the different types of risk. Um, how many are there? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 students. Each one of you learn one thing and then you just give 1 minute or half a minute explanation about what is each type of risk. Voluntary, there are 100 odd students, 9 topics are there. So I think each one of you can come out with 1 point. Half a minute also, if you talk about, that's more than enough, because these are conceptual knowledge. If you have, that's sufficient. So you don't even have to open the textbook, hard copy, soft copy. Um, Anything you type it in Google also, market risk, it will give at least one line information, minimum one line information. So at least you will get that. So talk about that for half a minute tomorrow's class. We're going to wind it up in another, how many more classes? I don't know. Max, it will be 3 to 4 days. We will wind it up. So please take it up and then talk about it. Will you? Will you? Anyone? What are the different types of risk? Or should I explain that? That at least you tell me. Should I be doing that or will you take it up? Small assignment only, no? No response at all. Okay. Mm. Having done so much, why should I leave even one slide? So let me explain. Risk is because of some uncertainty happening. See, there are different categories of risk. The first one talks about what is market risk. Market risk is the risk that there would be failure in the market. They would not be able to do well in the market, maybe because they do not perform well because they cannot meet the customers expectation, or there is a failure in the market, is referred to as market risk. So in connection to market risk, we also see that why would there be a failure in the market? Maybe because their products and services are not doing well. So sometimes product risk is also referred to as market risk, because they're not performing well in the market, because the products and services fail in the market. We can refer that to be as market risk, or very specifically we can talk about it as um, um, product risk separately. The products are not doing well, therefore it is not doing well. So um, then because of uh, dealing with the products, there are price fluctuations, therefore they are not able to do well in the market. Anything to connect to those aspects about, because of the price fluctuations, because the market they are not doing well. Sometimes some factors affect the um, business drastically, that their products are not sold. Sometimes certain rumors are spread out in the market about the quality of the product, etc. Few years back, around about 4 or 5 years back, there was a some information passed on in the market that um, you also must be remembering. I do not know whether you remember it or not. See, it was an information which was passed on stating that in when Maggi noodles were tested in the lab, they did not match the required standards. There was some harmful ingredient included into that. Therefore, it is not safe for um, the health of the children. So that was some information that was passed on. So that affected the reputation of the company. So it was a situation where people started dumping the products also, that which was purchased also, people started dumping that in the market. It was a chaos, complete chaos. It was on the verge of uh, the brand exiting from the Indian market. It's not about across the world, but it's only in Indian market. That's one example. Sometimes maybe it is genuine, maybe it is not genuine. For some companies, the reputation of the products and services also do get affected, and then that will cause them not to do well in the market. Their products and services automatically fail. So anything that happens in the market, if they are not performing well in the market with respect to the products and services, because of their quality, because of they do not meet the customers expectations, because of the reputation getting affected, um, for all these reasons, then we see that um, there is risk present in the market. Okay, so that's market risk. Legal risk. The legal risk is self-explanatory. Legal, because of changes in the rules and regulations. If there is any amount of risk that is present, is called as legal risk. So why would there be changes? Because of change in government, change in political scenario. Uh, the when governments change, when there is a change in the political framework, see, across the globe in different economies, we see that different things keep happening because of political instability, unrest, new governments taking charge. Then they come out with new rules and regulations. They do not want to follow what the previous government has decided. So such kind of things will cause change in the legal framework, the rules, the regulations. Okay. If those things happen, then there is a legal risk. Okay. Any changes in the economy on account of political, legal factors, if there is any impact on the organization, we call them as legal risk. Credit risk is credit risk that um, See, credit is a concept where to attract the customers, the credit facility is extended to the customers. Goods are sold to the customers on credit basis. They are supposed to pay the amount promptly on the due date. But if they fail to make the payment on the due date, it will be referred to as bad debts. We know that. Okay, that is the risk. The risk that the customers fail to make the payment is called as credit risk. Okay. Reputation, I already explained to you what is reputation risk. The reputation of the business, when it is affected, it will have an impact on the transactions of the business. Many stakeholders will not come forward to be associated with the organization, and that will result in the failure of the company. It is just not about the customers. Sometimes we also see that the other stakeholders, like the investors, the credit, the investors, the creditors, the suppliers, they do not like to be associated with the company because of the reputation that gets affected. So any risk that is faced because of the reputation getting affected is called as reputation risk. Liquidity. The concept of liquidity is about converting their assets, current assets, into cash. That's the concept of liquidity. um, See, there is investment made into fixed assets, investment made into liquid assets. So um, when investment is made into current assets, the purpose behind that is these current assets are easily converted into cash, and with the cash they are able to meet their um, dues or current liabilities or on the due date, and run the business. They can also support their working capital. That is the intention behind investing it into current assets. Now, if these current assets are not converted into cash, if there is a difficulty in converting them into cash, then in that case, they will not be able to meet the current liabilities. They will not be able to make the payment for their operating expenses. See, if the liabilities or the creditors are not paid their dues on the due date, what affects is the reputation gets affected. See, then in future the supplier will change the terms and conditions. Maybe discounts will not be given. Maybe the supplier will stop extending any credit period to the credit facility to purchase that. See, these are aspects which we see in connection to liquidity. If they cannot convert their current assets into cash to make the payment of the creditors and meet the operating expenses, and then in that case, any amount of risk that is faced by the business is referred to as liquidity risk. Business probity. Probity is the concept of probity is about the truthfulness, honesty. Okay. um, See, if we are talking about the honesty part of it, the truthfulness, it is referring to the ethical aspects of the business probity. The risk about their honesty, their fairness, their truthfulness. See, if it is connected to that, if it is connected to the ethical values of the business, and if it is felt that they are not ethically sound, if the organization is not ethically sound, they are not honest with certain aspects of it, if that has an impact on the business, that can be referred to as business probity. Health and safety or environmental risk. See, wherever it is environmental issues, there are certain things to be complied. There are certain rules and regulations which are laid out for the organizations which have to be followed. So when we talk about environmental aspects, uh, um, the generally in case of environmental aspects, there are certain rules and regulations, which there are certain specifications that are mentioned to be followed. Okay, if they do not follow, okay, if they do not follow these measures, then in that case they can attract fines and penalties and fines and other things. See, anything to do with environmental, see, um, there are different types of cost in case of environmental aspects. See, the conventional cost of utilizing the resources, etc. Then if at all, um, if they do not take proper measures, then that can have an impact on the um, health of the people in the organization, because of the pollution that is emitted, that can affect the health of the people in that economy. If that is the case, then that will have an impact on the reputation of the organization. If the reputation gets affected, then they can lose on the customers. The customers stop purchasing goods from them. See, lost sales is one thing. Then see, they are supposed to comply with the rules and regulations to reduce the impact that is there. If they fail to comply with the rules and regulations, the one impact is that they can lose on the customers and the sales. That is one risk. They can also have the risk of being penalized for not following the measures appropriately. Then they can be penalized with the tax, with fines, etc. So anything to do with the environmental health, safety measures that have to be followed, any risk that arises can be referred to as health and safety or environmental risk. Uh, Next one is derivatives. I'm assuming that you know about what are derivatives. So if you don't know, also I will not be telling you now what is derivative. Um, See, derivative is a it is a um, when it's a financial instrument when dealing with the losses, um, to minimize on the losses that can happen when they enter into agreements to minimize the losses. So they deal with derivatives. So on account of dealing with derivatives or using the or being involved in the use of financial instruments, if at all, if there is any amount of risk that is present with, because they are dealing with derivatives, is referred to as risk on account of derivatives. Then we see technological risk because of changes in technology. See, whatever investment they have made into technology then can become outdated. So all that will become a loss. So technological risk is because of changes in the technology. Whatever was invested already, if it becomes outdated, freshly they will have, again have to invest into technology once again. So that would be referred to as technological risk. All of them have, you have to have the conceptual knowledge. Will the question be on any one of them, or will there be a direct question? No, you won't get direct questions, but there is an expectation that the person who's writing this examination has a thorough knowledge about different aspects of it. This is one topic, and under risk is categories of risk is one thing. Let's see, the case study is dealing with risk management. One section of that case study is dealing with risk management. So the question can be, identify what are the possible risks that can affect that particular company, the company which is there in that scenario. If you are not aware conceptually what are the different risks, will you be able to identify what risk can affect that organization? So you will not be able to identify it because you do not know what are the different types of risk. If you are aware of that, then immediately you will be able to connect to that. So theoretical answer, it is a general answer about what are the different types of risk. See, if you read that, if you have a knowledge about that, you know what are these concepts about that, you will be very quickly able to connect it, relate it to that particular company in the case study, and then give out your opinion about what are the risks that can affect the business and what measures should be taken to deal with that risk, mitigate the risk. So that is how your approach would be there in the examination. Another category is about sector specific risk, business risks that are generic, that will affect all the businesses. Okay. um, there are risks that affect only specific business industries. So let's say that in a particular type of industry there is a material that is used. So if there is non-availability of that material, only one industry, one type of industry and the businesses in that industry only will get affected. Specific. So some risks can affect the all the businesses. Tax rate change in the tax rate can affect all the businesses across the economy. So those are called as generic risk. Specific to a specific type of business or industry, we call them as specific risk. Risk assessment, I did mention to you about how risk is measured. Calculation, assessment of risk is, I will explain this as the last topic. From risk mapping, we will take it up in tomorrow's class. How is risk calculated? First, events are identified. Event identification is one thing. Identify the events that happen internally, externally. Make a list of it. The happening of the event is not risk, but the event when it has an impact on the business, which is quantified. Take that impact. The events have an impact on the business, quantify them and find out what is the consequence of the event, consequence of happening of the event, that is taken as impact of the risk of on the organization. Monetary value, this is one variable, it is multiplied into the likeliness of such an event happening, the likelihood of the risk actually occurring. We identify maybe 10 items are identified, but what is the chance that it would happen exactly? See, we are in rainy season. Um, Morning news says that it would rain during the day. So if it would rain during the day, does it mean to say that 100% it will happen that day? What's the chance of rain happening? It is a rainy season, it is a rainy day, but after sometimes it can, the sky can become clear. It may not rain. So what is the chance that it will rain? Is there a 80% chance, 100% chance? Does it have a 20% chance? So what's the chance or what is the probability that it will happen? Mere listing out the events is not sufficient. Event and the impact it has on the organization. So after that, e- what chance does it have? The multiple events, each of the event which is identified, the chance of the probability of happening of the event also has to be identified. So event number one, what's the monetary loss? What's the chance of it uh, to happen? Event number two, what's the consequence? What is the probability? Event number three. Likewise, all the events and the impact these events have on the organization, take them with respect to each event. What is the probability? Identify that, multiply the impact into the probability. The sum total of all the events impact into its respective probability will be risk. Okay, so that's how risk is calculated. Okay, that will be the last topic today. So tomorrow we will continue with the other topics. Any doubts? Any area? Any doubts? Okay, then let's wind it up. You don't have any doubts? Okay. I'll meet you tomorrow.